All right, thank you. So I'm going to be presenting joint work with Jim Besson and Maarten de Goos and William van den Bergen, where we asked the question, what happens to workers at firms that automate? And this is, of course, related to broad literature that considers automation to be a labor-replacing force under some conditions, even in aggregate. But the empirical existing evidence on automation has so far mostly studied those aggregate impacts, for example, the labor share, and has focused on robotics, mostly in manufacturing sector. So what we're trying to do in this paper is to actually see at those firms that are automating at the micro level what happens to the workers that are employed at that firm, which was hopefully going to give some insight into any adjustment costs that these workers may be facing when these technologies are being adopted. So the contributions that we hope to make in that way is actually, to document those worker level impacts. We're going to be doing that by directly measuring firm level automation expenditures. And we're going to be doing that not only in manufacturing, but across all private non-financial sectors. And for empirical identification to get at those causal effects that we're after, we're going to be exploring the timing of automation events across firms. And then lastly, we'll also be comparing the impacts of automation to those of computerization. So very briefly on the data, so we're using Dutch data. It's administrative daily records, matched employer-employee data that we link to a firm survey that includes a question on automation costs, defined as costs of third-party automation services. This is a survey, but it is an official bookkeeping entry as well, so this is a familiar term to these firms. The downside of this measure is certainly that we don't know the exact technology that these firms are purchasing, okay? We have informally talked to some of these firms, and they come up with some examples that sound like, kind of a broad set of automation measures, but it is we see these costs arising in all different sectors, so it's certainly more than just, say, robotics. And then we're going to be covering years 2000 to 2016. And very broadly on the data over that time period, what we see is a rise in automation costs expenditures per worker. So all else equal, workers are being exposed more to these sort of automation at the firm level. We also, as I already mentioned, see this across all sectors. And anecdotally also, firm size, firms that are larger have higher automation costs per worker. So there's also some components there. Now, how are we going to be leveraging this information to say what happens to individual workers? Well, we're going to be defining something that we call automation spikes, which basically is just automation events, which in our baseline specification, we just identify as when the firm spends at least 3 times as much on automation relative to total operating costs than it does normally. So the way to think about this is a firm-specific measure. So this is indicating when the firm does something that, for that firm, is a big investment in automation. Right? We have other versions of this, but this is what we're going to be reporting in the baseline. Now, when we then see sort of what this looks like, so here, among all firms, we see that only 1/3 of the firms in our data actually have such automation events. There are a lot of firms that don't spend anything on automation. If we look at sort of in event time, here's the automation event, and then around that we plot the automation cost share as a percentage of total cost. We do see that these events are quite sort of sharp differences distinctly from the other time periods. There's a bit of a lead up and lead off, but there is this sort of big increase in that event year that we're going to be using for identification. And why would we expect to see that? Well, this is basically means that this investment is quite lumpy, right? And there's a whole other literature on investment studying showing that, both theoretically and empirically, that this arises when there's irreversibilities and indivisibilities, which may come from, say, fixed adjustment costs. And major automation events are likely to, meet those 2 criteria, we think. So there's likely to be some, irreversible investments, say, in training your workers, and you have to reorganize your production process, comes with some fixed adjustment costs. That's probably why we see those types of patterns. Now, if we then broadly look at, how do these firms differ, the ones that do not have such automation events, which is the majority, about 2/3, and the ones that do, they automate more, they spend more on automation in total and per worker, but also quite strikingly, they are growing much faster in terms of employment growth. So these are the more sort of successful firms that are presumably, adopting these technologies. Since we're interested in studying what happens to incumbent workers and workers of these firms, we certainly wouldn't be comparing, workers at firms that automate versus ones that don't, because it's not likely to be very good counterfactual for that. So what we're going to be doing instead is we're going to be exploiting the timing differences of these automation events at the firm level. And in particular, we're going to be saying a worker is treated when their firm has an automation event in a certain time, and workers that work at firms that have automation events later in time, 5 years or more later, are going to be serving as controls. We're further only going to be looking at incumbent workers, so workers that have a pre-existing relationship with the firm, so they're not self-selected into the firm in anticipation of the event. We're going to be doing some matching, on calendar year. But really the identifying assumption that's crucial to this empirical approach is to say, from the perspective of those incumbent workers, the timing of the animation event is going to be exogenous, conditional on controls. All right. Now, that gives us just a basic diff and diff equation. I'm just going to skip it. All right, so we're going to be looking at the worker level impacts. Firstly, just overall annual wage income. what happens there. So this is an event time again. So this is the automation event. These are the pre-periods. We don't see much of a pre-trend, which is good. And then after the automation event starts, so the estimates are relative to the pre-event year, we see that treated workers are losing annual wages compared to control group workers to the tune of around 11% in total after 5 years. So there does seem to be some displacement that these workers are facing, some adjustment costs, if you will. Where does this come from? Well, we see these workers, these treated workers, are more likely to separate from the firm. So there's an increase in firm separation for workers that work at a firm that automates now versus one that works later, at a firm that automates later. And then that firm separation is followed by some rise in non-employment. What we don't see is any wage scarring. So these workers are not sort of experiencing long-term declines in their daily wages, unlike some other firm-level events have been shown to cause, including in the Netherlands, such as mass layoffs, right? So there's no sort of evidence of that. But there are adjustment costs coming from increased firm separation, non-employment. Now, you might have a lot of concerns about this sort of approach, and we have a lot of robustness checks in the paper. I won't be able to go over all of them. We do, the standard sort of permutation test, but mostly we also look at, what other sort of events could be occurring at the same time that we might, also be capturing. So we look at, mergers and acquisitions, takeovers, restructuring, management change, and sort of the results of survival of that. So we're reasonably confident that this is really an automation-related impact that we're measuring. All right, some other results we have, we see that some of these losses are compensated by Social Security, in particular unemployment benefits, but the majority isn't. So really these workers are facing these adjustment costs themselves, are paying for them. These workers are also more likely to switch industries and enter early retirement, and the effects are quite pervasive, for example, across industries. So this is not only driven by, say, events occurring in manufacturing. This is quite pervasive. And we don't find any displacement effects for the firm's more recent hires. So remember, I'm looking at incumbents, so those that have been at the firm for at least 3 years prior to the event. The ones that are hired in the intervening period, we don't see any displacement. So, they're likely better matched for the firm's new technology. They're hired in anticipation of the event, for example. All right. Very briefly then, we were kind of wondering, to what extent is this displacement that we find really specific to automation or just a result of firms adopting technology in general? So we're going to be comparing the effects to computerization using a partially overlapping survey on computer investments. Same empirical design, so we did all the checks. We also see the lumpiness in computer investment. We construct the same type of events. And then here are the results where we look at computerization events, excluding any automation events that occur in the same window. They're a little bit correlated, not a lot, but a little bit. And then automation events, excluding computerization events. And we see a very distinct pattern with automation leading to displacement, as I already showed before, so decline in average wages, but not for computerization. So there's sort of two potential ways that we could think about this. One is, maybe automation as, the nature of automation technology is more labor replacing, whereas computer technology is more labor augmenting. Another potential interpretation would be that some of the things were discussed yesterday, that, maybe computerization at this stage is more of a capital deepening kind of effect than any labor replacing potential has already played out before. In any case, at this presently, from the perspective of incumbent workers, automation is more labor displacing than computerization. All right, so just to conclude, we do find some adjustment costs from firms automating for that firm's incumbent workers. Those adjustment costs come from a rise in firm separation followed by unemployment, but no evidence of wage scarring. Still, on net, these losses are only partially compensated, offset by benefits, so there are some adjustment costs that these workers face. We see some other movement along some other margins, like industry switching, early retirement, quite pervasive effects, and at least at present, automation appears to be more labor displacing than computerization. Thank you.